Hey traders, I'm James, one of the content team leaders here at A1 Trading, and as we start today's stream, I wanted to let you know about one of our show's main sponsors, FX2 Funding. With all the craziness going on in the prop firm space, we're excited to share some of the solutions FX2 Funding has put together for their traders. First, FX2 is rolling out DX Trade, which is a web-based trading platform that provides traders a smooth trading experience. It also looks super cool too, but that's not all. By signing up with FX2, you get access to C-Trade. C-Trade is a trading terminal where you can create custom indicators or download ones from the community. Get access to all of this and more by signing up for FX2. So, for traders looking to get funded, you can get 15% off by using promo code A1Trading15. That's A1Trading15. The link and promo code can also be found in the description. Now, on to the show.
All right. Good morning, everybody. Hope you're doing well. I can unmute my screen. There we go. We got some music to start today. Hope you're doing well, everybody. Thanks for being here. Another day in a relatively quiet week that's still moving. I think that as the dust settles still from all of the volatility that we got last week, like the jobs data, the press conference, there was a lot of stuff happened. And, in the end, I think we're seeing the aftermath kind of play out. Last week, again, just to reiterate, we had cooler than expected jobs numbers. The market cheered that on Friday, and then has proceeded to kind of follow through. We're taking a look at the NASDAQ as we speak. The NASDAQ is making a really impressive push higher here. This is going to be if we do get a green day today, that'll be our fourth consecutive green day after the recent pullback that we've seen in the market. It looks increasingly likely that a new bottom has been found and that perhaps for now we're back in positive territory. So I want to talk about the NASDAQ. I want to talk about gold. A couple other charts that I want to pull up here today. Talk about the dollar, the VIX. We got a lot of stuff to talk about. But first, in terms of the NASDAQ, 17,800 was a pretty key level of resistance. We could see that this area previously was a real key level of support for buyers. And then when it broke, it completely slipped lower and lower, kept going down to this 17,100, which for now, really, I think we might even retested 17,000 on the dot. Bounced hard from there and have started to put in some higher lows and higher highs. So it seems like bulls are doing just fine here. Thicky Nick, what's up, man? Thank you very much for the $20 donation. Wow, that is awesome. Thank you so much. Appreciate that. Thicky Nick, your name changed. I believe you used to be Nicky Nick from LA, and now you're Thicky Nick. So congrats. Maybe you've been putting it in the gym. Very nice. Appreciate that. The $20. Thanks very much. Ahoy, Nick. Yes, it's Pirate Month. I got my hat and I got my sword. So we are fully embracing the pirate themed streams here this month because why not? So again, yes, nice little push here for the NASDAQ. Can the win streak continue? To me, the likelihood is yes. Again, higher lows, higher highs, looking strong from a price action standpoint. The S&P 500 also looking really good. Broke levels of resistance here. I would say good shot that even if you do get a pullback, buyers are going to come running. I could be wrong about that. This could just be, some sort of one extended lower high. But for now, again, it looks like the path is clear for more upside. So yes. Cameron says, are you still offering the free course from yesterday? Yes. Message us on our website, a1trading.com. Someone from our team will help you out. Okay, so again, S&P looks good. However, I don't have any setups on the S&P, so I'm still a little bit cautious because there are some things that I don't love about the recent push higher. And if we take a look at indices specifically, let's go to the indices. Nope, that's the commodities. Let's go stock indices for a moment. So S&P 500, we're getting a neutral reading. So why the neutral reading if it looks so positive? Well, the trend is starting to look good, but there's still some things that were not so promising in my view. The economy cool down that we've seen, advanced GDP numbers came out lighter than expected. Services and manufacturing PMIs came in light. Jobs data, yes, came in light. And the market here, guys, is cheering this stuff. Are they right in cheering weakening economic data? That's the real question. That's where the debate lies. The quick answer, the short-term answer is yes. They are correct in cheering the light economic data. Why? Why is the market excited about less than expected GDP prints, cooler PMI data, jobs data coming in light? Why on earth would they be excited about that? The reason is because this will mean that interest rates are going to more likely to see a rate cut this year. Now, expectations for rate cuts. Remember, a rate cut is very stimulative to businesses and the consumer. Think about this. If everybody can go borrow money a little bit easier, everybody's going to go spend a little bit more money. Businesses are going to like that, right? Not only that, businesses that need to borrow money, if the Fed funds rate comes down, borrowing costs come down, and that is also advantageous to businesses. So why on earth is the Edge Finder giving it bearish readings? Well, because in the longer term, the question is the Fed truly going to be able to pull off a soft landing with all these rate hikes that have been baked into the system? Is this going to come out beautiful on the other side? I think there's a possibility, yes, but I actually like the idea of seeing inflation start to cool. We have not seen that yet. We're seeing inflation still sticky, but economic data coming in light. That's the issue. If you have inflation coming in light with this data, very exciting, because then this would counterbalance a lot of these score reads, by the way. If you got a +2 right here, that would shift the reading dramatically. But problematically, we have sticky inflation and we have cooling economic data. Okay. So that combination is the idea of stagflation. Now, Jerome Powell made a clear point that he does not see the stag or the flation. However, just because he said that, he's going to say that. He's the Fed chairman. But if you put all your faith in the Fed, I'm telling you, that is a dangerous, dangerous place to stay. The Fed has had many errors in the past, because who can blame them? Trying to control the economy is an incredibly difficult thing to control and to predict. So they're going to make mistakes. So the idea that they're just going to have a perfect soft landing, to me, is a little bit, naive. The market is priced for it. You can see the market ripping here today, and I am long. So I'm not saying this like bitter as a bear. I'm not even a bear on the market. I'm just saying that before you get euphoric about this stuff, just remember that there's a possibility that we could see the economy really take a turn, and usually it overcorrects in one way or the other. If they think that the economy needs to cool down from this, everybody wants to see this before this, right? That's what they want the economy to look like. But likely what could also happen is that they do get the economy to start rolling over, but it rolls over a lot more than they wanted it to. Does that make sense? Hopefully that does. If it makes sense, do me a quick favor. Hit the thumbs up button on the stream. Somebody asked what the hat was about. It doesn't come with the Edge Finder, unfortunately. Those hats are too precious. But the hat is we're pirate theming this month just for fun on the live streams. We're on a beach right now. You can see the sharks swimming around above me. That's why I'm not going in the water. I'm just going to stick on the beach and get sand to my laptop as I day trade for a living. So yeah, exactly. So anyways, let's talk about the dollar here for a second. So the dollar index trying to hold support around 105, and it's doing a decent job. But I made this point. Why is the dollar holding steady here? Why isn't the dollar, dropping through this level here? If jobs data came in cool and economic data seems to be lightening up, it's because compared to the peers, right? The U.S.'s Western ally, central banks like Bank of Canada, Bank of England, the ECB, they are also looking like they are seeing their economy slow, and the economies of those places might cut rates sooner even. So the dollar in that case looks relatively still supported to a degree. I'd say if you're a dollar bear, watch for a breakout of this level. If you get a break of that, then okay, now you may see the dollar continue to correct lower. Somebody asked me, Nick, why does the Edge Finder have a bullish reading on the Euro USD? It's clear that the European economy will need to cut rates sooner. That seems to be the picture that's being painted. But remember, guys, it's all about forecasts and expectations. Everybody forecasted the dollar to just be indestructible and the economy to not crack at all. It's starting to show signs of cracking. And so that cracking is causing some repricing of the euro against the dollar. It doesn't mean that the euro is just outright the better economy. You have to be able to displace these. You have to be able to kind of parse through this stuff a little bit. The euro may just be seeing a corrective move. Doesn't mean it's going to trend up indefinitely. But right now, again, economic data out of the US starting to slide a little bit. And that's perhaps making a short-term bullish case for the euro. I actually think that that is a valid thought process. What I'd like to see on the DXY, as I mentioned, would be a break of that support level. But for me with the euro, you'd probably have to see a pullback to this level. I've got it marked up from yesterday's charts, 1.074. I like that area as a possible area to look for longs in the short term. This is not a long-term indefinite, I favor the euro. It's just, look, the economy out of the US might not have been as indestructible as everybody thought. Perhaps there's a short-term corrective move on that. That's the difference between trading and just long-term investing, right? If I was just long-term investing, if you ask me, do you think that the euro is going to be higher or lower in 2 years? My opinion would be lower. But as a trader, I'm not, buying and holding or I'm not holding on to a trade for 2 years very often, especially not in, if I'm going to trade FX, right? What do you think? What do you think about dollar yen? Will it go up further? I wish I had a crystal ball, I'd tell you, but I don't have a crystal ball. However, in my opinion, the yen still looks weak. However, if it does break this level, right? I've made this point. I'm not long. I'm not short. But if it breaks this level, perhaps the yen strength is real. Like perhaps intervention is a bigger thing, because at one point I made yesterday is this. Several times there's been little like blips where the market goes lower really quickly and then just gets bought up really hard. Right now we saw a big move lower that has not been bought up. We haven't seen a V-shaped recovery. So if you take out this level, perhaps the intervention is a little bit more sticky, and with arguably some bear cases forming on the US dollar yen could be an interesting one to watch out for. But in my personal view, dollar yen is not like the one I'm going to trade. If I'm trading crosses, like if I'm trading FX, it's going to be the euro. But really, I trade currencies rarely compared to what I trade like the most, which is like gold and indices. I'm already long gold as sort of a proxy bearish move on the dollar, but not entirely. I just like gold also for a number of reasons. I'll show you the bullish reading that we're getting on the Edge Finder for gold. It's based on a number of things. The commitment of traders data. Let's look at COT data really quick. By the way, if you're looking at on Twitter, yes, we have it. Very cool. We've got people hanging out with me live on Twitter. Shout out to my Twitter friends. If you're live on Twitter and you'd like to try out our software that you see me using here periodically on my live stream, there's a link that should be pinned below this message. And if you're watching here live on YouTube, we'll drop a link directly in the chat to where you can try out the software for 30 days. If you'd like to get some information about that, please click this link that's being dropped there. And you can fill out that little trial application form and get you set up there. There it is. Very cool. Try out the Edge Finder there. Awesome. Okay. So, I was saying that gold on the commitment of traders data looks half decent. Take a look at this. Gold is the biggest in terms of a long percentage proportion over the contracts traded on the CFTC's non-commercial commitment of traders report. Gold is the most heavily, proportionally wise, long on gold, long of the whole list that we track. On the flip side, the yen is the most bearish. Oil is also bullish, the Nikkei, silver. Now, this, I make this point often, but to reiterate for new friends who are watching the stream with me, this section of the COT data, the long-term positioning, changes very slowly, very gradually, and it's not incredibly useful for day traders and swing traders. Because, if you've been watching me for a while and I watch the commitment of traders data for every week, this data, gold has been like a buy for like a year. So that doesn't tell you very much. However, what does tell you is how much is this changing week to week? Are they getting more bullish or are they getting more bearish? That's why we built this secondary table down below. So this table right here, guys, this is what traders probably want to pay more attention to. This shows you on a week-to-week filing basis, are they adding to longs? Are they adding to shorts? Are they decreasing longs? Are they decreasing shorts? This right here, this table that we built here, the latest weekly filing, that is going to be arguably the more important component of the COT data in my view. So, so check this out. If we're talking about gold for a moment, on a net percentage change, which you can find our calculation, we generated this column through a calculation. If you'd like to read about how that calculation works, head over to a1trading.com/edgefinder-tour, and you can read all about our system and how it scores everything top to bottom. Our full algorithm, everything that we've got, it's pretty transparently written out there for you. So if you'd like some information about that, you can find it at a1trading.com/edgefinder-tour. Okay, so gold saw a modest 0.4% shift positive week over week. They decreased longs slightly and decreased shorts relatively aggressively. So think about that. Think about this as one person's positions. Let's say they're hedging and they have longs and shorts open on gold. If they decreased a lot of their short positions and decreased just a little bit of their long positions, is that net bullish or net bearish? It's net bullish, right? Pretty intuitive. So we built this table to help you spot that a little bit easier because that's very hard to do in your head. On the flip side, you had NASDAQ, SPX, the Dow Jones, silver, the pound. These are things that were more sold on a week over week basis. Again, I mentioned it a moment ago, but if you would like to get access to the Edge Finder for 30 days, if you'd like to fill out our trial application, please click the link that's been dropped just now in the chat. If you're live with us and if you're watching on Twitter, it's the pinned comment down below. Okay. All right, so let's go back. So what else can we talk about with top setups? Now, when I talk about gold's bullishness, that was one column. The Edge Finder does not just score based on commitment traders data alone. While the COT data is great, it is lagging to a degree. And also it is, not the holy grail. Institutional money can be wrong about stuff, believe it or not. And sometimes they're on the wrong side of the trade. So that's one column in the Edge Finder's algorithm. We also look at retail's positioning, seasonal trends, momentum in the market, GDP figures, PMI numbers, retail sales, inflation statistics via the CPI, and jobs data and interest rates. So we look at all of these different points to build a general bias. Now, this weakening economic data trend that I've been talking about is contributing to the bullish read on gold. So why am I bullish on gold? Did it do a fancy head and shoulders pattern? Did it do a fancy support level? Did it hit a trend line? No, those things are perfectly fine for entries and exits. But here is the real thing here. The real point that I want to get across is the economic data coming in light. That's what gives me the more conviction to be bullish on gold. So again, I think a lot of retail traders, they obsess over technical analysis because it's easy to understand and anybody can do it. But if anybody can do something, that's where, you lose me. If everybody can do something, you just lose a little bit of the edge or the factor. Fundamentals are far more difficult and far harder. So typically good things worth having are not easily attainable. Fundamentals are work, like straight up. There's so much work to keep up with all of this stuff. But fundamentals are directional building tools, in my view. That's why we built the Edge Finder the way it is. So I am directionally bullish on gold, and technically using support and resistance, using simple textbook technical analysis to get in and get out. If there's any validity to technical analysis, and I'm not saying that satirically, I think there is. The only reason technical analysis would work would be on the basis that everybody can see the same things, right? Technicals are self-fulfilling prophecies to a degree. If everybody sees the fabled all-time high of Bitcoin get broken out with conviction, that's all psychology. If that breakout happens and that drives a bunch of momentum into the chart. Same thing with the S&P 500 when it broke all-time highs this year or last year. I mentioned that that's really bullish, that's probably going to really propel a lot of buying, and it did. So my point is, technicals work because they're a self-fulfilling prophecy. So with that as our basis, technicals need to be very simple so that everybody can see them. But technicals alone are not what I base my trading on. Technicals are the red lights and the green lights, the stops and goes, while fundamentals is my navigation system. That's like my analogy on the subject. Okay. So fundamentally, there's still geopolitical risk in the Middle East. Yes, there's talks about ceasefires, but you can't really predict that stuff. What I much prefer to lean in on is the economic data that we know the central banks around the world are really watching. And if we see cooling economies, that's bullish for gold, because people might start to say, hey, the economies around the world starting to cool. Maybe there's a bigger case for, a slowing increase in possibility of a recession at some point. That's bullish for gold. Why is that bullish for gold? Because it might mean the money printer turns back on at some point. And if the money printer turns back on, we know if they print a ton of currency, it typically gradually works its way into the price of gold. Jamie Murphy, that's a good point. If you click on COT data on the Edge Finder, it highlights that one bar. I'll have to look into that. I'm not exactly sure why it works specifically on that. I'll look into it, Jamie. That's a good point. Hold on, I'm going to write it down. Top setups, highlight bar. So just some context for fun. Outside of these live streams and outside of my trading, I spend most of my day in business management and software development mode. It's like after these live streams finish, I'm working on the Edge Finder with my team. We're working on marketing plans. We're working on helping, people with questions. So I do appreciate any feedback you guys give us on the tool and anything we can do to improve it. I constantly do my best to listen to the community, try and, we take it as good feedback. So thank you. Appreciate that. Do you think as a futures day trader, the Edge Finder still would be relevant to me to use for a filter for potential setups? Absolutely. The Edge Finder is really, it's built for specifically traders who trade futures, Forex, people who trade not really individual stocks, but most markets can benefit from the Edge Finder. Now, if you're a day trader, it also can be beneficial to you, because the Edge Finder's ideas, the bias generated, is not a time frame specific entry and exit signal. The Edge Finder just simply gives you directional bias. So if you trade the 5-minute or the daily chart, this is simply telling you that the economic data leans bullish. And a lot of times day traders will say, well, I'm a day trader, I don't need fundamentals. I would argue quite to the contrary. If you understand how fundamentals work, now if you're a day trader, let me tweak your idea. Do fundamentals matter to day trader? Absolutely. Because if you understand on the day of a big event that this new data will drive a big shift in the market's sentiment, if you understand the fundamental story, you can absolutely day trade it. Fundamentals are absolutely not just for swing traders. Fundamentals are for scalpers even. Let's say, I'll give you an example. You might say, no, they're not, Nick. Your scalpers don't need to think about fundamentals. Well, try this on for size. If you fully understand fundamentals and you know what it means when jobs data comes out very hot and wage growth is very strong and unemployment stays very, very low, if you can spot that immediately and you understand fundamentally what that means, you can totally take that down to the 5-minute chart and scalp it. It's not what I do. I'm a swing trader, but I'm telling you, the fundamentals can still be relevant to all time frames. So yeah. I want to ask if the Edge Finder really funds your account. I'm not sure what you mean by that. If you're talking about how I built my account over time, yes, the software business is absolutely how I've been able to deposit. It's my day job, really. You know, I'm a software developer by day and a trader also by day. But yeah, no, I use the Edge Finder in my own trading, and also we've built quite a following, which has generated a lot of returns overall. And just so you know, also with the Edge Finder, we're in constant developer mode. Sometimes what companies and services will do is they'll build something standalone and just sell it as is forever. But what we've tried to do here at A1 is, when we have a surge in sales, the first thing we do is we write up just tons of new projects. We have so far to go on this software. We've come so far, but we have so much further to go. So the money that generates from selling the Edge Finder copies, a large portion goes right back into what we're doing here. It goes into our support team. It goes into, developing new tools. It goes into, like I said, programming costs and maintenance costs. So we're far from over with developing this tool into the best product it can be. Would you consider adding other commodities such as corn, wheat, soy products to the Edge Finder? I've thought about it. We do advertise it as something useful to futures and FX traders. So it's possible that perhaps in the future we will make the additional, soft commodities that are offered in the futures market. It's possible. So yeah. Okay. So like I said, I am long gold. Current positions for me. Let me see if I can get you guys caught up to speed here. So in terms of current positions, pull this up here. There it is. Okay. Current positions. I am long gold, as I mentioned. So there's the gold position. I have a long position on XLK, which is a ETF or a collection of stocks that are focused in the technology sector. So I've got a good sized position on that. That's been going pretty well. At the same time, we do also have VOO. This is just the S&P 500. So I have S&P longs, I have technology longs, I have a solar panel ETF longs, which, wait a second, that TAN, what's going on with TAN? Hold on, I gotta check my TAN in just a moment. I have some shares in PayPal and Starbucks. I bought those recently. And TLT, my covered call position here, still in the red, but it's come back from the dead here. I mean, that trade was down like $3,000-$4,000 at one point, so it's come back a good bit. Let's take a look at TAN. So I have two different strategies, by the way. You might be wondering, like, what's all the option stuff? I have two strategies. My momentum trading strategy, which you guys are probably most familiar with on my YouTube channel or on my Twitter, where I'm, basically using simple price action, fundamentals, trailing stops. And then I have an option strategy, still fundamentals, but more mean reversion based. So I entered TAN. I sold puts. I got assigned on those shares. So now I have a long position on TAN. What is TAN? It's a solar ETF. So these are companies that specialize in solar technology. It's an area of the market that I think has a lot of potential growth. It's high risk, but it's also high reward. So I built out a very small position and I sold covered calls on my position. And so this is my current P&L on this, $842 on this trade. And I sold calls at $44 as my strike price. So if we keep moving higher, I'll basically take profits on this trade. So a bit of a mean reversion trade. What I mean by that is I use simple Bollinger Bands, oversold. Again, simple technicals, looking for oversold or overbought conditions to sell puts or covered calls. So the wheel strategy, but sort of an active trading wheel strategy. So yeah, there's current positions. TLT is another one. Really quick, I'll just do this. By the way, if you guys would like to check out this broker that I'm using right now, we'll drop the link to WeBull. It's a great brokerage if you're looking to that. I think if you're on Twitter, that should also be linked below. Yes, I think so. Yep. WeBull is linked in the pinned comment of the live stream if you're interested in checking it out. It's a really great platform. These are referral links, by the way, full transparency. If you choose to use one of my referral links here, you will be supporting our work. You don't have to. You can just sign up with WeBull without using my link. But if you want to support my page, I do appreciate it. So yes, that is some current positions. Let's talk a little bit more about the momentum side of things. Question is the NASDAQ going to persist? I really thought, and I could have been wrong about that. I could be very wrong about this. I thought that there would be a little bit more strife to this rally, and it's surprised me. So I have a convoluted view of the stock market right now. I am bullish, but not incredibly bullish. I'm modestly bullish. And so if I'm modestly bullish, I mentioned when we saw this big sell-off that I was buying. Again, I showed you my positions. I bought the S&P 500 VOO, right? I bought VOO. I bought XLK, which is a technology sector. So I have long positions that I built into this sell-off, which are looking great. But I didn't get full exposure to the market. So I'm not 100% invested. I don't have all my, full, margin on the the long side. But I mentioned that I thought we might see a possible further dip, in which case I could actually build a bigger position on stuff. So I held in my stock brokerage that I keep showing you, the cash side, I stayed a little heavy. And so I'm kind of regretting that, obviously, in hindsight, shoulda, coulda, woulda, just gone full in right there. But nobody knows where the bottom of a pullback is. But I was wrong and right at the same time with this move. I was wrong because I thought we would see more of a pullback. But I was right because when push comes to shove, I bought some of this dip. So I bought the dip, but I would have liked to have been able to buy more of it. That's where I'm at. The reason I didn't buy more of it was because I thought, there's some valid concerns. Inflation data is sticky. The economy is, slowing. And so I still think that there may be some choppiness ahead. And I talked about that with Chris Pulver yesterday on the stream. Talked a little bit about how you may get some further choppiness. It may not be a straight shot, through the highs. But if it is what it is. I'll just make the profits on the positions that I have. But again, I would ideally love to see a bit of more of a corrective pullback. If it happens, I may be able to get more positioning. Hopefully that makes sense. I know it's a little convoluted.
Anybody else ever felt like the chart is talking to them like this?
Exactly. The chart feels like it's talking to me. RTY, this is the Russell. Russell, I did take a loss on this one, and I'm glad I took it when I did. I've had a couple of these recently, a couple times where my stop loss ended up being, the best thing that could have happened to me, because again, had I held on to this short position, it now would have been, much, much worse. I closed out pretty quick, took a loss on it. I also took a loss recently on silver, which is a little frustrating because I took this loss right here. So that one did not look so hot. But took a loss on silver. It's okay though. I'm in a okay position so far on gold. I have those, like I said, the long positions on the stock market that are looking pretty good. The options plays are doing okay. Here's another one recently that really I was thankful for the stop loss approach, because I had a long position over here. I thought that with all the tension in the Middle East, with the strong economic data out of the US, that we could see a continued push on oil. Now, let me cushion myself here a little bit. I caught this move here. I made some pretty good money on oil so far in 2024. But then when it fell apart, the stop loss ended up being the best thing that I could have done here. I took a stop as we broke this low. So I did take a loss. I think I can't remember how much I lost, but I lost on that trade, and it ended up being one of the better decisions because the market proceeded to drop much lower. In fact,
I love trailing stops.
so 80, yeah, exactly. So 81 broke this level. Big breakout at 81 here lower. And so when it broke that, that to me is just like, okay, I'm staying out of the way of oil. It's no longer on the top setups for the Edge Finder, so I don't have any positions on that. And I'm just going to continue to watch that. Some of the yen pairs might be interesting too. We do see some of those looking, bearish on the setups terminal here. Euro pound, euro dollar, gold. So also TLT, I'm liking to see this in the the US 10-year bonds showing up as a bullish reading on the Edge Finder. I like to see that because, again, like I said, I do have a bullish position on TLT, which is, again, long duration treasury bonds. The 20-year yield is down nicely today. And, it's interesting. Why aren't you seeing the NASDAQ up, 0.5% today on this drop? Is this perhaps, maybe the cooling economic data is not as positive as people thought? I don't know. We'll see. Again, TLT is a position that I have on. It's still in the red, but it's really come back to life. I have 1,000 shares at an average price of 91.93. I sold puts to get into this trade. I'm in the trade now. I'm still in the red on this, but if TLT, if yields continue to come down, if economic data continues to come in a little light, we could very well see 20-year yield continue low. I mean, this is really breaking momentum. Here's the daily chart. Check this out. Momentum's starting to fade here in terms of the upside on the 20-year yield. If you take a look at the 2-year yield, yep, you can see 2-year yield came back and retested this 50-day moving average. 10-year yield and hasn't quite retested that. So we'll see. But it's really broken the momentum of the 20-day moving average, which was kind of that line of defense. Broken that, so now retesting lower. We'll see if that persists. Real quick, guys, we're going to be joined here in just a moment by Chris Pulver on the show, the A1 Trading Show. We'll be right back with Chris just after this quick break.
Attention A1 Trading Show fans, if you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker Eightcap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to Eightcap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
All right, we're back to the A1 Trading Show with Chris Pulver. What's up, Chris?
Hey, Nick. Hey, listen
Got a
to
little
that.
claps for you today. That's awesome.
Very nice.
James,
What's happening,
James
man?
on the soundboard. Not a lot. Just watching here the open as we, Chris, I think today I'd be willing to, well, not willing to bet because I know I could do an options for this and I know you'd call me out. But I don't think we're going to see much of a move today. What do you think? I mean, Palantir earnings, we could talk about that. That's kind of fun, but you don't have a lot of juice today in terms of anything else, right?
Agree. I'm gonna throw something out there that I'd love to see. Let me share my screen here so Chandler has it in the background. I would love to see a little bit of a fade. We have a lot of pivots out there in the daily and weekly realm. So what I'm noticing is, maybe the big turning point's not gonna be until next week with CPI, but the fact that this market has not acknowledged that we just had a pretty solid, 5, 6, 7% correction. And it's not like this was a V bottom, Nick, right? I mean, we go from this high to this low in a pretty fast, 3-4 day sell off that took a couple of weeks total. But then we go little bit up, little bit up, little bit up, and the market gets all excited. So I kind of like to see this. If I can zoom into my chart, you can see these little pivot guys. We have 3 in a row. 1, 2, 3, also a fresh weekly and fresh monthly. So What I'd like to see today, this is the NDX. I'd love to see this pivot get hit around 18,045. I got a chart alarm set at 18,000. I'm calling that one out because I've got a pin butterfly price today that could be a potential 10x return. Now, issue is if it doesn't get hit today, then I'm going to take a loss on NDX. But if it does get hit, this thing is rock solid for a huge gain. So I'm cheering on the Bears a little bit today. But that being said, I mean, what I see objectively is if I look at the SPX, I see a gamma level up to 5,200, which is higher highs. If I look at the NDX this morning, NDX right now, gamma levels, I'll float this out there. Let's go into the 5-minute chart. I mean, you're not seeing anything to the downside. I mean, that's 18,051. Fudge. I think I'm gonna be a little screwed on this trade today. I'm pretty sure. It's not a big deal. It's annoying. I mean, if we have indecision, like you said, if we have no movement today, okay, big deal. But here's the SPX and the SPY. I just want to show you these levels. This is the SPX, and the levels I see filling up right now, 5,200. So we could have just a slight gap fill today, and then just a bit of a rally towards 52. The SPY. These all change like intraday. If we have some big buyers come or some big sellers coming in and these start to fill up to the downside, then I'll watch the intraday. But the SPY right now, which easy instrument for a lot of traders to watch, we could have a gap fill right in here, just this baby gap fill right in here, and then head back up to the same highs. And the big gamma level I see today is at 520. So if there's a directional play, it still looks like we're just going to drift a little bit higher. If that's not the case, I mean, one thing that you and I both know has happened since last week is we got crazy fat gaps from Apple last week on Thursday to Friday, and then from Friday to Monday. I'd like to see one of those at least try to get filled, because it's just what is it right now that's making this market so freaking optimistic? I don't know. This week is just earnings. Disney's down like $10 from yesterday's close. Palantir's down, even though earnings were solid.
I think Frank nailed it. We'll have to hear from him a little bit. I think he nailed it on
He
his.
did nail it. He
his
got some profit on
play.
that. Yep.
Yeah, I think he mentioned with Disney and Palantir, he had a volatility play, and I think we'll have to hear it from the man himself in a little bit. But I believe Disney and Palantir both huge moves, and he's making some money on that. So very cool. Disney, Chris, I want to own some Palantir, but I've been saying that for me, one thing I'd like to buy this company. I'd like to stick some in the portfolio for the longer term, but I want to see the market freak out a little bit first. I don't want to buy this thing in euphoria mode because, one thing that I heard from their earnings report, they have an awesome product. I mean, it saves companies a ton of money. It's really cool. They do a bunch of data, extraction and AI stuff. And what you need to know is, the simple stuff is General Mills, I believe, said that they saved like $14 billion or something, or not billion, $1 million using their product in the last year or something. On their earnings call, there was this really excitement. General Mills has found this ancient company has found a way to plug into Palantir and save a bunch of money. And that's a model that gets me excited because I'm like, if Palantir is getting paid X number of dollars to save companies way more than that, there's a lot of potential there. That being said, though, they also mentioned that slower growth areas like Europe and the government, that they're not seeing as much, appetite to spend with them. So it's definitely a cyclical to a degree kind of company.
Sure.
AI stuff, first thing to get bought by companies right now because there's not a proven monetization path just yet.
Yep. We talked about utilities yesterday, right? We talked about utilities maybe being the place for AI infrastructure in a different way versus going like growth and throwing money at companies that claim they're going to have all these revenues and claim they're going to be the next big thing. Utilities might be more of the defensive, slow play. One thing I'm gonna pivot to this for you. One of my followers posted this today in my trading room. I know that the font's really small, but this is what the markets are pricing in currencies. First cuts and probabilities. So we had talked about this. We think that most central banks will be cutting prior to the Fed. There's a lot of monetary policy divergence out there right now. And so I thought that the most dovish banks would be, besides the Bank of Japan, which is now technically not dovish. Number one, they're off of negative interest rates for the first time in over a decade. Number two, they're intervening whenever they feel like it, whenever that is, and
Sure.
nobody knows. But the Bank of Canada, Bank of England, Bank of England, Bank of Canada, ECB are going to be three of the more dovish banks. RBA, RBNZ pushing out some potential rate cuts, maybe not even cutting this year. So RBA right now showing that there might not be a cut. Bank of Japan, possibly another rate hike in June or July. And then the Fed, we looked at this yesterday. The CME Watch tools pricing in about 2 cuts, September, December are the
Hmm.
probabilities right now. So I just wonder if we're going to start seeing some moving and shaking because now we have monetary policy divergence. All this can change, but all eyes on the Fed. If the Fed's going to cut twice, now I'm wondering if other central banks are like, okay, the Fed's going to cut September, December. Bigger central banks maybe cutting this summer. Maybe BOC, BOE, ECB cuts like June, July. Obviously, we'll find out in the next month or two. But I still wonder. I mean, what are your thoughts on the dollar? I mean, your DXY. I still like the dollar index posture at this time, as long as we stay above 103.80. It's a messy currency, your index right now. But if we stay above 103.80, 103.90, I think this is a chance for traders to buy a dip that's really easy. If you, oops, I'm gonna use a black line here. If you buy here with a tight stop loss and you are paid on that trade, that's a good trade. But I wouldn't take this big basket position on it. It would be it either works or it doesn't. And that's kind of my outlook on the dollar.
Yeah. No, I think in terms of what's going on right now, the dip on the dollar, there's a valid dip going on because now there's not this like impenetrable US economic data fortress that, all the other currencies are just getting smoked by. I think
Hmm.
that has cracked a little bit. So you're getting a little repricing on the dollar. But I lean with you, in terms of the dollar itself. Um, I still think that the bigger picture is US outperformance. And if US outperformance is going to persist, the dollar's a decent play on that front. Now, in terms of the general direction of central banks, I think you can play gold for that, right? Because gold reflects, yes, it's priced against the dollar, but the spot price of gold goes up beyond just what the US dollar is doing. If there's news, I mean, you can watch, Bank of Canada press conference or ECB or Bank of England, you can watch the price of gold and it's moving too, even though it's not quoted in pounds or euros here. So
Right.
I think that from a directional standpoint on central banks globally, I think it's fair to say that likely we are going to see some cuts start to come in,
Hmm.
and that's going to be continuing to be bullish for gold. But specific to the dollar relative to its peers, I still think that the U.S. outperformance could be a thing.
Yeah.
But I'm also just very curious. I mean, if you lose the inflation side, if you do get like the next round of CPI data coming in really light, I think there's still going to be room to the downside for the dollar. But again, the bigger picture, the longer term, I'm still dollar bullish, I guess, in terms of an outperformance perspective. That's the best way. I think, as you mentioned, that bigger term picture, like 103.8, you said, yeah,
Yeah.
I think you might see on a cool inflation print, you very well might see the market make a move down there. But then, yeah, I think when the dust settles, you'll probably be also met with weaker data out of Europe, weaker data out of the Bank of Canada. So it's again back to as we've been saying, Chris, on our show here, it's a best of the worst kind of
Sure.
trade. All currencies are kind of seeing the economy start to cool after all this rate hiking that we've seen post-pandemic era. So I think there's a trend towards rate cuts, and it's now the question of who are you're betting on the least physically hurt horse in the race, right? Which horse is going to run the best, I guess, with
Yeah.
injuries
The
that it
one that can
has.
go into the stable instead of being shot behind the barn. I
Right,
guess.
exactly.
Yeah.
Yeah.
Yeah, I mean, I'm just watching the technicals because I just looked through the dollar basket. I mean, Aussie dollar nowhere near confirmed. And right now, I'd say that the euro dollar, pound dollar, dollar CAD may be my top three. If I'm going to see dollar strength, those are probably the top three I would prefer to trade as opposed to the others. I think Aussie dollar, New Zealand dollar, also commodity back for both of those too.
Hmm.
The Aussie, New Zealand might perform better than the euro, the pound, and the CAD. So that's just my outlook. I mean, if I like the trade, it's probably going to be take a short on the euro dollar, take a short on the pound dollar, and take a long. I'm already long on the dollar CAD at this time, but I'm going to see if this level holds. Gold, I'm still in. Silver, I'm still in. Bitcoin, I'm still in. I got some good fills there. We
Chris,
do
what
have
do
a
you
lot of
think about
earnings this week.
oil? What
Oil,
about oil? 'Cause you
yeah, you
mentioned
know what?
dollar
That's a
CAD.
good question. I looked
That's
at oil
probably
this
helping
morning.
your CAD trade, right? Because CAD weakening on weakening oil, I imagine. Am I right
This
about that?
actually, what the one that's helping me the most is my CAD trade that's benefiting me in currencies is Aussie CAD. I'm long Aussie CAD, New Zealand CAD, and this one's finally starting to pay out really nicely.
Okay.
I've been leveling in on Aussie CAD since we had this trend line break. I've been leveling in at these lows, and just every little trend line break, I've had 3 or 4 positions entered in, plus long on this larger trend line. So this is another one of those like investment positions where I like
Yeah.
this head and shoulders, left shoulder, head to neckline, and I'm looking to see if we can break this. And we're heading up towards maybe 94, 95. So there's still plenty of upside potential on Aussie CAD. I like this trade a lot. So this is the one I'm actually benefiting from. Dollar CAD, I'm just kind of in with a bigger swing. So because the dollar's been getting some pullbacks, but my stop on dollar CAD is below this low, and I have trade one here. Trade two is a pocket fill around 35.50 that hasn't been filled yet. So I'm looking to see if this dollar CAD will just consolidate and then maybe make another push up towards 39. Now you said oil. I looked at oil futures this morning. So here's oil. Here's the price. I said that if we don't really breach, 77.50 to $78, I'm still looking to be a bull on this. But I'd feel like an idiot if I decided to get into an options trade on USO or oil futures and this thing just stays red.
Sure.
So I don't think I'm going to touch oil right now because I said the easy trade is why would I guess here when it's so
Hmm.
much easier down here? Like
Sure.
buy that level and don't
Yeah.
guess where this thing's going to bottom out because I don't really know what this is. Like why is oil falling outside of there's been more supply put into the markets, there's been higher production. Um but it's been weird. I mean, I think since we've had cooling inflation and I know we have CPI and PPI data next week,
Hmm.
um I do think that that data point, I think we talked about this yesterday in the show. I think that data point is going to intentionally come in better than expected.
Yeah, and that's the thing, Chris. You mean you have a couple things here that are tricky about the price of oil right now.
Yep.
Uh, Political concern in the Middle East. I don't even like trading off that, Chris. Like I just want to point that
Yeah.
out. A lot of people, that's the first thing they'll point out is like, oh, Israel and Iran and Hamas, and like yes, but you can't predict that stuff at all. Like there's no, what I can do with economic data is I can at least say here's some trends that we're seeing. Like although that might not have been a great example, like Friday's NFP, if you looked at it and you said, well, 5 months ahead of this we've had higher than expected prints, that's a trend that you can at least spot. Now, there's a sudden change in that trend. That's something you can trade. That's something that you can like observe. But for me to say, as just a guy on the other side of the planet, like, here's what's going on in the Middle East. I think this is going to happen. I think for me to speculate without being
Right.
anywhere near the action is like, I can't do that. Now,
Yep.
can I apply just a general risk premium if things do seem escalated? Sure, but I can't predict what's going to happen next.
For
That
sure.
risk premium right now, though, seems to be coming out a little bit of the market. So why is oil down, gold up? Well, I think I would say, Chris, that the slowdown of the economy helps gold, but it hurts oil.
Definitely.
That's my best guess. Would you agree? Like, is that the idea?
Yeah, because your slowdowns were here, right? Your slowdowns were here. This was the explanation for why we had, lower oil prices is the global slowdown, the China
Hmm.
slowdown, the US
Yeah.
slowdown.
Yeah.
All those reasons were why oil was just stable, stable, low, low, low. And then all of a sudden we got the rip up here. Um, this this by the way, like this price action, was this wasn't Russia Ukraine. Russia Ukraine happened before that. Um,
2022. Yeah.
yeah, so I mean, I don't even know what that is other than just technicals. I mean, that's the thing, man. I can attach and pretend like I know what's going on. It's like I don't. I mean, all I know is the market can absorb so many geopolitical things and not even acknowledge it. But it is strange to see that oil is down from these recent highs. I mean, we've had a double-digit pullback on oil, um, high to low. We're looking at about 11% correction.
Yep.
I still, here's what I will say. I'm willing to take a trade in oil if I see this. If I see something more convincing, I'll probably put in a credit spread and take an oil stab that goes maybe back up into this range, and see if I'm right. And it would
Yeah.
be defined risk. It wouldn't be anything crazy. But ideally, I don't do anything until it's so obvious. without guessing, just in case this gets lower, lower, lower. Because last time we had this move, right, we did drop a lot in oil, and all of a sudden we're talking about oil at a bargain level, which maybe that happens again. Maybe we get to 70, $69 and it looks a little bit more attractive.
Yeah. Also,
But
Chris, just to I thought about it for a second longer while you're speaking on that September move in oil.
yeah,
I remember what was going on. Inflation was ticking back up. The market was correcting because remember going into like October, this is 2023, stock
that's
market started to
true.
look terrible. So there was a rush for the energy sector. Inflation was driving prices higher. There were still conflict, concerns about, I don't think it was the Middle East, but I think like China and Taiwan was a concern at the time. So I think, you could tell a story at any time for why the
Mhm.
market makes a move. But I do remember that a lot of people, I remember during CNBC, everybody just pumping on the XLE, be long energy because the market's going to go back and hit the lows again. And then sure enough, as the inflation yields started dropping off a cliff, that really smoked the price of oil as people said, see you later, oil. Inflation's no longer, and we're going into tech. And tech just
Right,
flew back through the highs. So yeah, I
right.
just remember just fun times. But yeah, I sometimes will do that, Chris. I'll like just go back in a random time in the chart and be like, what were we discussing? And what's so
Yeah,
fascinating to me is the story just changes dramatically over time. You
yeah.
go back and find a chart and be like, wow, we're not talking about any of those things anymore.
Well, and this, I mean, you talk about storied markets. I mean, that's what this entire year has been. It's like last
Oh
year
yeah,
was the hype of AI and the recovery off of a 2022 reality check, and 2023 was not the broad market. It was the Mag 7, and then the Mag 7 quickly became AI, and now it's all NVIDIA and it's semiconductors. It's like it's funny how the market can just latch onto a narrative and run with it. It's like it constantly makes people feel like they're missing out. Like, how do you
yeah,
not know that it should be everything's in? I mean, I've looked into the research and found 10 of the top like semiconductor based ETFs, and I'd had a conversation with somebody yesterday. Somebody asked me if I would trade Boyle for natural gas, which
right.
it looks attractive, but it's like Boyle's not a long term anything. So if I want to be long natural gas, which by the way I do want to be long natural gas, but there's no good way to play it for me. If I did, let's see, NG should be nat gas futures. Yeah, so if I go nat gas futures here, I mean, we are well off these lows, which is great, but I couldn't get the trade that I wanted outside of doing like naked puts on natural gas, which obviously would pay out here now. But it's
Sure.
like I mean, this goes back to February, March of last year. There has been little to no excitement in natural gas outside of people just getting, their lunches taken, eaten, whatever, like all day long. So I mean, I don't know. You can look, you can observe, you can comment, but sometimes it's like sometimes not trading is still good trading. If you really don't know the instrument or know the rhythm and cadence behind it, like cocoa futures, we talked about that yesterday, right?
Mm-hmm.
I don't think I'm going to trade cocoa futures. It's like it's
Sure.
just a parabolic move that's starting to come back and revert to the mean, and there's backwardation and contango and all these crazy stuff in the options world. But Boyle, for example, is like a double or triple leverage instrument. I
Yeah.
was looking at trading. I mean, those are great, but those are not meant for anything long term. Like literally, those can be repriced within like days to weeks. And if you don't time that really, really well, you will get hammered on some of those leverage instruments.
Yeah.
So I
And
just don't think the investors
speaking of
know that.
cocoa, Chris, I don't know if you
Yeah.
saw this. It's up 10% today.
Is
My
it really?
goodness.
Yeah.
That is just insane. 10% in a single day. Just casually, I'm going to go buy
There it
a
is.
chocolate bar at the store and it's going to cost me 10% more than yesterday. That's just crazy.
Well,
Now it's going to
what
cost me a
look
dollar
at this
10 instead
though.
of a dollar.
Look at this right here. You got to give props to the old Fibonacci's. The low to high pull back to the 618. It bounced
Oh
right
my
there,
goodness. Yeah.
and it's right at this. And what does this mean? I have no idea. We could go. I mean, if you didn't pick the level to go long on cocoa futures, I would say the next spot would be okay. So we pull back into there's support, there's resistance. We could pull back into this area. If we go
Yep.
high, low, this would be your dead cat bounce where it's like cocoa's up and then cocoa's down.
Mm-hmm.
Or I mean, I would say this. I would still sell. I would maybe take an options play, Cocoa futures. If we somehow get back to 12,000, I'd take a stab at that with an options play.
Yeah.
Define risk, nothing crazy. It's like I'll risk $500 on that trade. If I'm right, maybe I can make 500 to 1,000. But I'm not going to get caught in this whirlwind of price action that I can't control.
Sure.
It's just nuts, man.
Yeah, it absolutely is. Chris, I remember there was a time, I'm trying to find it, a couple of years ago. I remember on Bitcoin, it did something similar. There it is. Like Fibonacci's, man. Sometimes it's the simplest stuff. Like it's almost like markets get so complicated, but then this is just
Yeah.
like, is it too good to be true? Is it too easy? Just buy the 61.8% retracement. Yeah,
Right.
it probably is. But sometimes when it works, I mean, this would have been the risk to reward factor of a lifetime if you had
Right.
played that Bitcoin. Obviously, Bitcoin, it's not, if you're long at any point in the last 10 years, you look like a hero. But
Sure.
I had somebody, Chris, on I was talking about a little bit of my performance here on Twitter recently, and somebody was like, "You've massively underperformed Bitcoin." And I was like, "You are very correct." I was like, I don't know
Yeah.
one trader on planet Earth that can outperform Bitcoin, like on the long-term basis.
Well, I mean, I guess your Michael Saylors of the world will outperform
I
when
guess so.
they're gonna hold their entire company hostage with a Bitcoin holding. I mean,
Yes.
MSTR, by the way, 1274. I mean, this was essentially looking like a parabolic Bitcoin there for a moment, and then reality came in, and
Yeah.
they've had a 50% correction since those all-time highs. And on top of that, this earnings report on MicroStrategy is terrible,
Yeah.
right? And they had this huge. And why is it back up? Because it's Bitcoin. I mean, it is crazy. Like this company's sitting on 100+ thousand Bitcoin that, with the real value, is like $6 or $7 billion. I mean, they could cover all of their debt if they wanted to. Honest, I've got this. This is interesting. If I go to Snowflake analysis, I'll just find a little spot check on MicroStrategy.
Yep.
It, I mean, it's not included in any of this, right? This is this is MicroStrategy on a Snowflake analysis. Dividends, nothing, right? Highly volatile share price, less than 1 year of cash runway with a company that has $6 billion in Bitcoin holdings. Okay.
Wow.
Unprofitable, not forecast to become profitable. Like this is crap from a fundamental standpoint compared to, I mean, let's just say MicroStrategy, it's tech. It's not a Microsoft by any stretch, but just at a glance, if you did a Microsoft, okay, look at the difference of, is this more attractive? Yeah,
Right.
right. But
Exactly.
Microsoft doesn't have $6 billion of Bitcoin. MicroStrategy does. I don't know what the end game is here, but I think at this point, if you know the story of MicroStrategy and Michael Saylor, that the guy's not selling, the guy's not wanting to cash in. If anything, I think when the stock price is up here, he was cashing in on MicroStrategy shares, but not Bitcoin. So it's, again, what I don't even know what I was talking about with this outside of, there's just a lot of wild stuff going on in Bitcoin. I mean, what did I do here? There's a low, there's a high. We came back to the 618. Nick, you and I could probably find a ton of charts where you get these big swings, just drag a fib on it and see where the
Mhm.
market responds. And we did that on the SPX. I mean, I'm looking at the SPX, SPY. I've done the same thing here. I mean, take this October low to this all-time high. This is why I'm still wondering, can this market justify a bit more of a correction? I mean,
Mm.
having a 236 pullback on a 5 or 6 month swing and a crazy 25 to 30% rally usually isn't how indexes perform.
Yeah.
So,
Yeah. No, I think
yeah,
I think a lot of, in the short term, a lot of the fears that we had have washed away, but that doesn't mean that at some point there won't be, more fears. Like maybe we go sideways for a little bit and maybe
hmm,
new fears come into the picture. But like right now, a lot of those things like Middle Eastern conflict, rising 10-year yields,
yep,
earnings, I mean, all those fears right now have washed away. It's why the market is recovering right now. But again, it doesn't mean that new fears won't come around the corner. It's like, the story always changes, where there's always a wall of worry when it comes to the stock market. And yeah, I mean, it's usually the new emerging fears that cause a new dip. So we'll see.
sure. Well, and I know that Frank brought this up yesterday. I mean, have you sold anything on your TLTs? You were assigned on TLT, right? You still hang on to that?
I'll show you my position here.
Okay.
I did get assigned. I
Okay.
am in the red, down $1,000 on my TLT covered position.
Okay.
Now, so I got assigned. I wrote a 92 put that I sold. So I got
Okay.
assigned. Oh, sorry, 93. Collected $1.07 in premium. Got 91.93 as my average fill price. I'm in the red on my position. I've sold calls that expire. I sold this like 1 month. So this is a monthly call that I sold for like nothing, like no premium, because the market had moved against me a bunch. So
Right.
there was just not enough premium. I still sold it just because I was like, you know what, it's better than nothing, I guess.
Right.
And I'll take the position. But now I'm feeling a little better about TLT, Chris. I mean, with the round of data that we've had, I don't hate the idea of like, you know, if I don't get called away from my shares, I might still write a little bit of a further out of the money call again, and just like let me hold on to the shares if I can, because again, I think now you're starting to see the TLT story come back into play. In fact, on the Edge Finder, I believe we actually have a bullish reading currently for
Nice.
10-year bonds, and that's kind of filtering in. You know, you've had weak economic data that's giving a nice read. Inflation's pushing back on it, but again, as you mentioned, if we get a light print,
Yeah.
I think TLT might look really good, but we'll see.
Yeah, the light print, and I guess we'll find out more next week, because does the light print mean that we're all of a sudden going to have the Fed change the like the CME Fed Watch tool again? It's looking for 2, and then we have a
Mhm.
light print in inflation. The market's like, no, 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 the Fed might cut 3 or 4 times now. I mean,
Yeah,
it would be like, just imagining like the slinky effect of coming into the year thinking 6 to 7 rate cuts, to 0 to 1, now 2, and the market's like stoked about 2 cuts.
yeah,
um it is,
it's
I don't know,
weird.
man, it's just super emotional. It's like the market is so emotional, it's like it wants to latch onto something. And then that does make trading fun, when it's like you can latch on to a narrative that, yeah, I can be confident in the,
Well,
like the SPY or the index is going another 10 to 15% higher, as opposed
yeah,
to, at best, I think right now at best we go retest all-time highs. If this doesn't pull back, I mean, I'm looking at the markets today, I'm watching very closely, but if we don't have like a red day today, and this is just another green, green, green with 3, 4 gaps in a row,
yeah.
I mean, at best, I think we test the highs, and then we just fade this thing next week with CPI data. I don't know,
Yeah,
man.
we'll see. Chris, so here's the thing too. You know, you mentioned that the narrative around rate cuts being the narrative. I just want to show you this really quick.
Okay.
So let's do this. I'm going to do a little top bottom action. We'll do 10-year yield on the bottom here. Okay. And let's just go just straight price. I'm going to put the daily chart. Okay. So I just wanted to show you this because I thought this was interesting. So in this October, November rally, as you
Mhm.
know, it was brought on by yields dropping, and people were
Yes.
thinking, oh my gosh, 6 rate cuts. This is going to be amazing,
Yep.
which never made sense to me. I mean, obviously hindsight's 2020, but if you go back, you know, Chris, you and I were both like, do you really want 6 rate cuts? Like, that's not actually a good thing. If you're gonna have 6 speedy rate cuts,
Right.
speedy rate cuts are like always the sign of a recession. Like
Right.
historically, slow rate cuts are what you really want. So the thing though is that the market, you know, got super excited on this, but then yields started to go higher, and
Hmm.
yet the market kept going
I
higher.
know. I
So
know.
that's the weird part. But then I guess what you could push back, what somebody will argue is a good point for why this sustained, is that earnings have still been impressive. So
And
yes, we
buybacks.
lost the yield, yeah,
Yep.
buybacks, you know, return to shareholders. So there's an argument for it. But again, I still think that to get overly euphoric without this narrative, look how just simply powerful yields
Yep.
dropping were for that rally. To say, oh, it doesn't matter anymore, that's weird to me. You know what I
It
mean?
is
Like, that's the weird part.
definitely a disconnect. And looking at this, this recent little drop in rates, I mean, I don't see rates getting repriced super aggressively when we still haven't had a cut. Even if the market's going to price it in, this is a buy the rumor, sell the news. I mean, we're still going to be sitting at best 4.75 by
Yep.
the end of the year. If we have 2 cuts, where it's going to be 25 basis points. The Fed's not chopping 50 basis points off right now.
Sure.
Other central banks, I'm curious if it, like we said, the Bank of Canada, ECB, Bank of England, if they start cutting this summer, or any central banks for that matter start to cut this summer, what type of chunks they take out. I would imagine no bank is going to cut more than 25 basis points at this time, and they'll take a cut, they'll test. And I did look at this. I think I still have this up. Inflation by country, and I just went through the list this morning on the G20s here. And I mean, let's go to some of the G20s, and let's go alphabetical. Okay, so let's go kind of our major currencies that we trade quite a bit. The previous print, Australia was 4.1, now 3.6. Their rate's 4.35. Canada 2.8, 2.9, bit sticky. Canada's got a lot of stuff going on, with their housing situation. With they have variable interest rates for their housing. Those repricing are going to be. I don't think it's really being talked about a lot, but this could be a crisis on the brink with Canadian real estate.
Yeah, I think it's
I
worse
mean,
there than it is
it's
in the
nuts.
U.S., right?
What's that?
It's worse there than it is in the U.S., I think, for
Absolutely. And
Canadians.
I wonder if this is going to be like, there's going to have to be some type of help. I mean, if you have, I don't know. I mean, think about, so the US right now, because of COVID and refinancing and moving, like that quick, like 1 or 2 year period where everybody was moving, relocating, leaving cities, vacating, whatever. But everyone locked in. I think right now, about 90% of mortgages in the US are like 6% or less. And I
Yeah,
think about 65 or 70% are sub 4. So our
sure.
mortgage rates are, and we're locked in for a true fixed 30-year mortgage. Canada has a variable rate that's reassessed every 5 years.
Yep. And
So
that's
if you,
that's
I
kind of
mean,
coming up,
could you imagine, and anyone's home situation that's watching right now, could you imagine, like, my house in Michigan is 2.72%. If I had that house for 5 years and I was forced to refinance at 7% at today's rates, wouldn't want to afford to be, I wouldn't stay there. There's no way that I would stay there. That's
Right.
insane.
It's just
So
too
it's
expensive.
essentially
Yeah.
tripling your mortgage, and
Yeah.
there's nothing you can do about it. So I do think that's something in the future, maybe the next 12 to 24 months, that needs to be really considered, because this is all happening. Because you think about COVID, right? 2020, with all these refinancings happen, what happens in 2025 when this variable rate is checked again?
Yep.
It's going to be another
Well, and then
round, and
on
it's
the
going to
real
be way
estate
higher.
front, Chris, you could also throw in there, just for added spice, the corporate real estate world in the U.S. is a
Yep.
nightmare.
Interest only expenses and debt restructuring, all
Yeah.
that stuff. Yep.
So regional banks, I mean, I am a believer of staying away from regional banks personally,
Yep.
just because, again, you're that's one area where I don't see, in the AI revolution, a massive increase in the demand for office space.
Sure.
So that's a tough one for me, but I don't know. We got Frank on the line. He's going to be joining us in just a moment. Before we bring Frank in here, Chris, I'm going to step out, give you guys the floor for a little bit, go through some stuff. I'm
Okay.
curious to hear about Frank's Palantir and all that good stuff that Disney moves.
Yeah.
But before I do that, let me just remind everybody who's listening, guys, if you're not already following Chris Pulver on his own socials, if you're watching on Twitter right now, it's at Real Chris Pulver. If you're watching on YouTube, we'll drop the link to Chris's YouTube channel. And also, just a quick plug for our own channel. Make sure to subscribe, follow wherever you're watching. We do this on a daily basis. Chris comes on regularly as well. We're adding value to the community. We're doing our best. So if you support our work, make sure to hit the thumbs up button, like the post wherever you're at, and subscribe for more. All right. Right after this, we're going to come back. It'll be Frank and Chris. If we just do a quick break here just to set up the cameras, we'll be right back just after this.
Thanks, Nick.
Real quick, I wanted to throw a shout out to our stream sponsor here on the A1 Trading Show, Forex VPS. If you haven't heard of Forex VPS before, they are a dedicated hosting platform where traders, especially algorithmic traders, can set up an in-the-cloud computer to run their MT4 24/7. If you have any experience trading with robots on MetaTrader 4 using expert advisors, they have to remain up all the time, and keeping your computer on is not always practical if you have like a power outage or that sort of thing. And with Forex VPS, you can set up a dedicated hosted computer in the cloud to host your MT4 or 5 platform. They have the fastest execution in the industry with latency less than 1 millisecond, which means when you place trades or your system places trades, it's near instant. So I've got my VPS open here from Forex VPS, and you can see, I just want to show how quick the latency is here. So if I click sell, you can see it is right away. I'm in the trade, all set, as if I was sitting on this computer, even though it's somewhere in the cloud. For stream viewers right now, Forex VPS is offering 30% off of your final subscription. If you're interested in giving it a shot, there's no risk. Why not? Use the link down below and the promo code there, A1Trading30, for 30% off. If you're watching this stream at a later time, you can also find it linked in the description below.
Hey Chris, what's up?
What's up, Frank? How are you, man?
Pretty good.
Good. Let's chat.
Yeah. So, what you looking at today?
Are you out of? So you and I were talking offline. We both got out of Disney, which was a good trade. Your trade on Disney. was a bit tighter than mine. My trade on Disney would still have some room to run if I was still in it. I can check and see what that would have been. I hate doing this because this makes me feel bad, but I took the trade. There's my 651 debit for an 825 credit. If I put the trade back in right now,
Nine.
$9.40. So it'd be up about $3 a credit versus $2 a credit, or $1.75 that I took early this morning. So just a little follow through. I should have held out a little bit longer. Anyway, it is what it is, man. It's earnings. It's a nice move to the downside. We'll take the profit. I'll say this. I mean, making $1.75. So I paid $6.50. $1.75 out of a $6.50 move. I still made 26.9%. I like the 15 to 25%. It's high probability. That's why I trade earnings. Get a couple of stabs like that. It's worth it. So I get it. It's just nice that, I could I have waited? Yes. But immediately, here's what can happen too. You can have the market gap lower like this and immediately start to fill that gap, and your value will dramatically shift where you're in profit at opening bell, and then later in the morning you're not. So it's totally fine just taking profit at it as is. Your debit, what was yours, like five something, and you closed it out at 7 something?
Yeah, I forget the exact number, but let me go back and check.
Okay.
It was so let's see, Disney was at 5.2, I think.
So a 5.2 debit?
Yeah.
Okay. And then you close it out for what?
It went up to a 692 credit, or 692 debit.
Okay, so you close it out 692 minus 520, $1.70 out of a 520. That's pretty good, man. You made 33% on that position. Nice play. Frank or Nick says something about Palantir. Are you out of Palantir already? Did you get out of that trade, or are you still in it? I'm still in it too. Okay.
It's not really showing much of anything profit wise.
I'm upside down on my Palantir. I've got a 3. It was an inexpensive trade. I think I got a 320 debit right here, and right now, let me go into the actual trade itself. So Palantir 1, 2, 3, 4. If I were to close it, it's trading about 295. I'm upside down about 25 cents. So I have the 2450. I mean, what's kind of stupid about this trade is, hang on a second. What's the trade that I'm in? I mean, we're trading at 21.58. That's real price. Yeah, so I'm giving it some more downside, but 24.50. Let's look at just the real value. 24.50 to current price is 21.50. This should be trading for around $3. Unfortunately, it's trading exactly at $3, and I'm not getting any extra time premium in that long side. So that's the good and the bad. I mean, my sell side, as far as the puts go, it's out of the way. I'm trying to give it some runway. I will be hopeful if we get to, 20, let's say $20. If we get to $20, could I have $4.50 and turn this into a 320 debit, turns into a $4 credit? $4.20 credit would be awesome. If I take $1 out of this trade, that'd be about a 33% return. So that's what I'm looking for as we move a little bit lower. Worst case scenario would be we have our gap right here, and then the market fills it. But best case would be that there's a little bit more pressure on the downside. We come in a little bit lower. If we can try to find this $20 zone, I'll probably take profit there, Frank. Getting in with the 24.50. If we get 450 of real value on the put side, and I traded it for 320, I'll take the profit there if I can.
Yeah, I would too. I'm still at break even from yesterday, but
Yep.
I kind of don't really want to trade Palantir anymore. I just want to own it, especially after a drop from earnings. I see Palantir being a good play in the long run.
Long run, yes, but well, I'll say this: if I'm looking at from technicals, here's what I'll say: I'm willing to take a stab at Palantir if we come back to like $16 or lower. I'll trade it. I'll trade it like that. I mean, $16. I can use active options to lower the cost basis. I mean, I did this on SoFi. I started participating in SoFi at $14. I own it now at like $7.30. That's just with options. So I mean, lower the cost basis. I'm long term on SoFi. It's not the same stock at all. I'm just saying based on this price action, I would like to see from this high if we pull back into at least this pocket or pull back into this cluster, this $16 to $12 area. That to me is where I'd participate. Use options to lower the cost basis. You want to be longer term, sure. That gets really exciting to own a stock at $12 with a high up to 45. Gets really exciting.
Yeah.
But let me look at something since we talked about Palantir. Let's see what this is really the tail of the tape. I mean, does it actually make money? Is it due to make money? Became profitable this year. That checks a huge box. Earning forecast to grow 26, almost 27% for the year. But it does say trading below estimate fair value. So Snowflake wise, it's okay. I've seen better. But it's also in a, so this is showing slightly overvalue with the, what is this? Oh, that's it. Never mind. I want to look at the discounted cash flow. So right in here. So it's showing that it's priced about right for discounted cash flow. But, and that's the thing in tech, I mean, you pay for the speculation, really. It's like you pay for that growth potential. But what is nice is anything that I've looked at this year that shows unprofitable and will not be profitable for X amount of years, I stay the heck away from it right now. Anything that's going this way with positive earnings over the next year, the next 5 years, I'm much more interested in getting some good prices first, and but at least fundamentally having some strength behind it. So anyway, just wanted to throw it out there for some Palantir. Other interest. So I know you and I talked about several other companies. What's that?
We're both in Trade Desk, but do we want to look at Shopify? Are you in Shopify?
I am in Shopify. I think did I tell you that yesterday? I thought I did. I took a trade on Shopify yesterday. So here's my Shopify for my trade room. We got into it's the same thing. I'm playing the volatility. 77 by 95 is the bull call spread. So I bought the 77 call, I sold the 95 call, and then I bought the 75 put, sold the 60 put. So I'm looking for about $15 to $18 of max profit. I likely will not get anywhere close to that unless the move is crazy up or down. But the expected move based on earnings is going to be around $13 to $15 based on the current price. So
I
Shopify.
have a question. When you're saying that your debits have turned into credits, does that mean the value went all the way to zero and then continue to go into the negatives?
No, it means that if I take a trade, so if I execute a trade for a debit, that means I have to close the trade for a credit, right?
Oh, okay.
So because I pay for the trade initially, I pay a debit to open the trade, I would close the trade at a credit. So even if it was a losing trade,
for a loss, would it be another debit?
No, it would be, so let's say Disney, okay? Let's say Disney as an example. I paid $6.50 for the debit. Let's say that Disney didn't go anywhere, okay? And I actually, this did happen on PayPal. I can talk about that as a real example last week. So let's say Disney right now had earnings and it went absolutely nowhere. Well, you'd be sitting at a $6.50 debit that today would probably be showing like a $5.50 credit, and then a $4 credit, and then a $3 credit. And then if you let it go all the way to expiration and it's still terrible, you'd show a $0 credit. Does that make sense?
Right. So that would just be a full loss.
Right. So if I open it at a debit, I'm looking to close it at a credit. So what I did today was an 825 credit. And so my net profit, that's a closed position. My net debit or my net profit was $1.75 per contract. So that was Disney. Let's switch this around because this happens too. If I do a credit spread, and I did this on SMCI, this was a credit spread. So I did the, deep in the money bull put spread and bear call spread. I don't remember which one paid me. I think it was the bear call spread paid me, but I don't remember the price on this one. Let's go to SMCI. Well, I'll just use an example. Let's say the price was trading, price is $150, and I'm just making this up because I don't recall what it was. And I do a deep in the money bear call spread. So what I did was I'll say that I sold a 130, sell the 130 call, and then buy the 135 call and I do that for like $3.50 credit. Now, when that trade moved and it pushes lower and it got me into profit, my $3.50 credit, if I did nothing and I let it go all the way to expiration, I needed to make sure that price was going to stay below 130. If it stayed below 130, I can keep the full $3.50. But what I did instead is price pushed into my area, got below that 130 for a couple of days, and so I closed for a $2.50 debit. So that gives me a net profit of $1 per contract. Does that make sense?
Okay.
Yeah. So when you open a trade for a debit, you're typically going to close it for a credit. When you open a trade for a credit, you're typically going to close it for a debit if you're closing it. Now, when you sell options and you're taking a credit up front, you're either going to manage that for that partial profit, or you're going to let it go all the way to expiration, let it expire worthless, and then try to keep all the credit you took up front. In the exception would be what you and I talk about with those broken wing butterflies. The broken wing butterfly trade allows me to take credit up front, and if we are correct on those pin prices, we can actually have an initial credit on the first trade, and it can still close as an extra credit if you're in that tent, right? When the price goes, if you're in that pin price where if we did a broken wing butterfly like this and price is exactly into this window, like if it's getting inside the tent or it's like pinned at that price, this is a credit right here up front. And then if you really hammer this thing towards expiration, this actually closes for a much greater credit. I've only seen, I mean, again, we got to be spot on with the prices, but I've had that happen, a few times over the last month or so by having some of these credits. I take the trade for $1 credit and I close it out for 50 cents credit. That means that I actually made $1.50 net on the position. But that's like, I don't want to confuse anybody because it's easier to think about it. If you open a trade for a debit, you're going to close it for a credit. If you open a trade for a credit, you're going to close it for a debit.
And so when you instead of the butterflies, when you're talking about a on SMCI, you were doing a bull or bear call spread, which is buying a call and selling a call below price. So this is what we talked about last week, I think, when you said you have the risk of assignment, as in the trade could just get called away because you have a sell and a buy call. But if you do it further out in time, like say you did SMCI 14 days out and you were 20 points below price on a bear call spread.
Okay.
So the odds of you actually getting closed out are pretty low until, say, like a day before the trade expires, right? Or is it possible or probable to get called out of the trade pretty early on?
So the expiration plays a little bit of factor on assignment, but it's really based on price. If I mean, options are made up of buyers and sellers. If there are buyers and sellers that want to exercise their contracts and I'm the seller of that option and I'm obligated to take the shares, if price moves quickly enough, I've had assignments that are months away from expiration, but I've had assignments because prices moved significantly enough where people are closing out their long options and I'm taking on the sell side of that. So I'm taking on the assignment side. Usually within certain expirations, and I mean, the odds of assignment are probably about, let's say 7 to 10% most of the time. You take an options trade, it's defined risk. Your odds of assignment are typically single digits. But if it happens, and I mean, I know in your case, you said if you get assigned, it's a margin flag or something like that, right? And it puts a little stain on your account for maybe a week or so. Is that what it sounds like for WeBull?
Yeah, that's what happened.
So I wasn't worried about the assignment because there's always a way. I mean, the initial trade for me was a defined risk trade. So even if I was assigned, and we use this as an example, so SMCI, we're trading at 821. So I don't even remember what the credit spreads were on this one, but it was clearly probably it was probably like a $2.50 to $5 spread. But if I did, so let's just say we do it right now. So we're trading at 821. If I were to do deep in the money, let's say I do a 900 by 895 bull put spread, and that means that I'm going to sell the 900 put. I'm going to buy the 895 put. And I'm curious what let's say we go out like 2 weeks. And what does that pay? I don't know, but it's probably going to pay us a ton of premium because it's the probability of that thing getting back up there is slim. But let's go out, to the 17th and do a monthly expiration on SMCI. If I did a 900 by 895, so I could risk 60 cents on this trade and make $4.40 if price gets all the way back up to $90. Now, what's interesting is by the 17th, this actually does show the potential that, well, it's a slim potential, but there's a 22% chance that I could actually get this trade back above my price. It's not a probability I want to take, but the nice thing is if I collected $4 of credit and I'm only risking $1, it's not a high risk trade. It's just a low probability trade. But if I took this trade and price goes nowhere, doesn't mean that I get assigned. Even though I'm whatever, $70 in the money here, doesn't mean that I get assigned. But if I do get assigned, let's say that we take this trade here, Frank. I get assigned, so we'll do a 900 by 895, and I'll just keep the numbers simple, and we do a $4. Okay, so we'll say we get $4 credit. Okay, so that's what we collect up front. That means we have $1 risk. Now, if we are assigned, this is what's nice about the trade. Okay, broker assigns us at $900 share price. And this is where traders just need to take a second, just do some simple math. If I'm assigned at $900, I still collected $4 credit on the first trade. So my break even is $900 minus the $4 credit. So if I took the assignment, I would own SMCI at $896. Okay. Now on top of that, I still have, and this is what happens if you get assigned. Typically, a broker that assigns you will let your long options still run, or they close them out together and wash the trade. Now, in my Schwab account, for example, my broker, so Schwab, never closes out my long side of the trade. A tasty trade, they'll close out and they'll exercise. So the assignment and the long side, they'll close it out, neutralize it, and then I'll just have the assigned shares. They'll neutralize it and they'll wash the assignment plus they'll wash the long side. But what I want to show you with the math is I still have the 895 long put that is running. Okay, so if price of SMCI is $850, my 895 is worth $45 credit, right? If it's still trading there, it's still worth $45 of real value because my strike price is $895. $850 is the actual price of the stock. That gives me a $45 difference. Okay. So if I cashed all that in, okay, I cash in the $4 credit. Okay. The $4 credit plus the $45 credit. That gives me $49 of total credit. And where's my assignment price? $900 assignment price minus $49 of total credit. It's going to equal the original dollar risk on the trade. Right? So this is why credit spreads, I mean, for some simple math, it's really a great trade where assignment risk is low. So that never sways me like, oh, I shouldn't take the trade because what if I get assigned? If you get assigned, you have a way out. You always have a way out. You're never going to get stuck like, oh my gosh, margin call, I blew up my account. Never, because it's a defined risk when you took it. So you can keep the integrity of the trade, even if it's broken up as an assignment, you can still close out the long side, close out the shares, be done with the trade and take, at usually worst case is it's no worse than what you initially took the trade for. The inconvenience is that, yes, you were assigned and it probably puts you in the red. The broker's saying, hey, you owe us money. And they typically give you a window to close it up within, 24 hours or so, which isn't that hard because in 2 clicks, I close out my long put, I close out my shares, I make the trade wash. So it's about the same risk that I took initially. And the same thing, my credit didn't pay out. My $1 risk was essentially what I closed out the trade for. So does it happen? Yeah, it happens. It happens all the time. I mean, we've had 100 assignments in my trading room the last couple of years, but this is how we manage them. So I just think I mean, it's unfortunate if the broker makes it more penalizing for you with, maybe that pattern day trading or the margin stuff. But from that standpoint, I mean, it's still, you have a defined risk trade. That's my point.
Yeah, it's not about the loss because your trade value stays the same. It's just your
Correct.
buying power goes away. And if you don't
Correct.
have enough, then you get margin called, or you get limited buying power initially. And then if you don't sell or close your shares after like a certain amount of days, so if you wanted to let the trade run to see if you could become profitable or not,
Yeah.
and you don't sell out of it, then you do get margin called, and that's the tough part.
That's true. But you have to remember too, if you're taking a credit spread and your thought is, I really can't afford to own these shares, then if you get assigned, you're just going to close out the trade and take the initial risk.
Yeah.
It's nice. Like in my case, I mean, I was assigned on Apple. I was assigned on Apple at 170 here on the weekly chart. So I'm assigned on Apple at 170. Just in a matter of a couple of covered calls, my cost basis now is down below 165. So what's kind of nice about this is I have a 170 call at this time to get called away with a break even around 164 and change. So I have a solid like $5 profit that I'm expecting to make by, I think, the end of June with Apple. Now, if price comes back in below 170, I'll just continue to sell covered calls and I'll continue to work my cost basis down, and I'll hang on to the shares. But I don't think my intention is to hang on to Apple shares longer than what I have, like probably out to June when they get called away. I also did this on Baidu. I have 100, and as you can see all this. This is what rolling cover calls looks like a lot.
Yeah.
So I took the assignment. I had a break even around $96. Put in a covered call. I rolled it out. Put in another covered call as a roll. So I roll it out in time, roll it out in time, roll it out in time, and then eventually I was able to roll it out in time and roll it up in price. So I had $100, $98 call, $98 call, then $100 call, $100 call. Now I have a $102 call. So what's nice is I've actually incrementally lowered my cost basis while also incrementally increasing my covered call price to give me more profit per share. So I started out with, 96.76. My break even now is 92 with a 102. So I went from expecting to repair this trade for about $1.25, $1.26, $1.24, I guess, $1.24 profit, to now I'm making, I mean, I'll make several $1,000s on Baidu if it gets called away. I think it's end of May. So in the next 3-4 weeks, this gets called away. I make $1,000, and I could probably look at it right now and try to roll it again. If I wanted to roll it, I mean, again, if I go out maybe another cycle, go out to the June monthly expirations, maybe keep it at 102 again, or like, can I bump it up to 103, 104? I mean, it helps, and if I can roll it for a credit and increase my cost or increase my profit potential, it's easy, as opposed to I'll just take the profit and take a brand new trade. I mean, I'm already in it, and I'm effectively just lowering my cost basis and increasing my profit potential. Also, I'm long in this stock too. I know we talked about this offline a little bit a couple weeks ago, but Baidu, I like quite a bit. I'm looking at this to hopefully stay with this wedge break. I'm looking to see if Baidu catches some gains to the upside. Another thing, Nick and I didn't talk about this too, but one thing that could also help sustain this market rally, not just U.S. but abroad, could be China. I mean, China has been way more vocal about supporting the economy, supporting their tech sector, supporting real estate, lifting animal spirits, so to speak. And there are some plays and exposure that I do have in China that they're right here. I mean, I'm not trying to keep all this stuff to myself. It's like I like Alibaba a lot. I like Baidu a lot. Baidu's a little bit more expensive on the Snowflake. I think Baba is a slightly better trade. So JD.com is another one. This one checks a lot of boxes. What happened to my Snowflake? What? There it is. I was like, that looks way better. This is JD.com. This is a retailer out of China. So I mean, to me, it's already been up quite a bit. I think there's a lot of upside potential. The bigger indexes, FXI, KWeb, those are ETFs that are cap related. JD is one, and then Baba versus Baidu. So here's just sounds like baby talk. Baba. but it looks really good. This is, if I'm not mistaken, this is the is Alibaba like the Amazon of China, or is it the Google of China? I can't remember what they do. Technology, infrastructure, marketing to help reach. Okay, I think this is like the Amazon. I think this is like the Amazon of China. So Alibaba, good trade for me overall. Longer term, I like the technicals. I'm hoping that, of course, time this well. Baidu is the same type of thing here. We just have really good price action and a really good technical pattern. And if this is a fulfilling prophecy, there you go. That's at least my target one. And then longer term, I'm looking to see if this measures out, hits symmetry. And we're talking about Baidu at, I mean, this could be a $250 stock if you give it time. So I'm trying to give it time. And anyway, so there's some exciting stuff on the horizon for at least some price support. And I do wonder if that also is enough to take us with the U.S. market resiliency and maybe China. That's, I mean, you're talking the two largest economies in the world. Whether or not they want to fight over Taiwan later, we'll find out. But for right now, if things are looking good for growth and good for some resiliency and two supporting economies where China's supporting their economy, U.S. is clearly supporting its economy fiscal policy wise, you can't fight it. You know, they say don't fight the Fed, but I think at this point it's like don't fight your fiscal policy either, because it shows how powerful it is.
Have you looked at Rivian?
I have. I know that it's up. So they have earnings tomorrow, I believe. Nope, Tuesday. So it's today after market. I mean, the issue with Rivian to me is, here's a good example. Okay, I'll just go back to this, and we'll look at the numbers. We'll just like we did yesterday with Disney. Rivian, currently unprofitable, not forecast to become profitable for the next 3 years. Insider selling, volatile share price. So revenue's forecasted to grow, yippee skippy, but still not profitable. And if it wasn't for this like emergency cash flow that they just received over the last couple of weeks, they secured $25 billion or something like that to keep operations running, probably give them another X amount of dollars cash for maybe the next 12 months, maybe the next 24 months. I don't know. This is in their Ohio factory, but it's a car company that I don't think plans on being a car company forever. I think they're trying to get like Rivian. The big talk was Rivian's going to be the Amazon fleet, right? Amazon delivery vehicles are going to be Rivian. Okay, cool. But is that enough to make them a permanent automaker that's going to be competing with the likes of, you know, GM and Ford and Honda, Toyota, Tesla, maybe?
Not health-wise.
Not health-wise. Definitely not health-wise.
Volatility-wise.
Okay, but what do you do with an $11 stock? If you want to trade options around $11 stock, let's price it out. Let's price it out, Frank. Okay, and then I'm gonna tell my Equities on Demand students we'll start the session around. We'll go live.
Well, maybe we shouldn't, because I know if we're expecting a 50-cent move either way, that's going to be a very bad risk to reward.
I'm just telling you, it's going to be a terrible price. Because the best you're going to get is probably 50-cent options, right?
Yeah.
And let's look at the numbers, because look, let's price it out. Let's do it methodically. Let's focus on the process here. So Rivian, okay, expected earnings around 14.92%, pretty consistent, getting double digits. So I don't mind going like 13 to 14%. So what's your 13 to 14% move on a $10 stock? Nothing, man. It's like you're going to get $1 to $2 movement unless it just blows it out of the water. So let's say we take a 14% move on a 1050 stock. Okay, so 14% out of a 1050 stock, you're looking at $1.47. All right. The weekly expected move is about $1.97. So if we can get appropriate options pricing, you're expecting $1.47 to $1.97. What you need to do here with earnings is you need to see Rivian do something great or something terrible. Because if it's great and all of a sudden this thing goes to, I mean, I'm not saying it's going to 20. That's probably impossible, but we could probably have some really surprise move at $12.50 to $13, $14. And it's like, oh my gosh, it blew out the market and expectations. And you'd make money on the trade. But let's price it out. So we're expecting a $1.50 to $2 move. Let's look at Rivian and let's see what type of options we have, because they're probably not great, but let's find out. So I would probably go to The 17th, I want to finish this up and make sure how often on the earnings plays have we actually hit a 14 to 15% move. Let's find out here. Okay, so maybe this checks a lot of boxes here, Frank. We'll find out. But this one does.
20%.
Yeah, we need to go 14. We need to go, let's say 13 to 14%. This one gets to 11.6. It's close, but doesn't count. This one, 13%. 15 to 8 days later, it's right on. I hate the cutoff at 8 days. Anything over that, there's no way I'm going to stick into an earnings play, 13 to 21 days out. Obviously, I could with the bigger cycles, but if I'm doing debits, I don't want to pay for those options. I want to sell those options. This one, right at expiration, a 13% move. You could probably get away with that one. This one doesn't get there. This one does get there. This one does get there. This one does not get there. This one does get there. This one does not, and this one does not. So we have 1, 2, 3, 4, 5 yeses, 5 nos. Flip a coin. That's about as good as it's going to get. If we priced it out, this is what I said. You're going to get at best 50-cent options. So your best play would be this. Let's see how much the broker wants to charge you. They're going to charge you probably $2 for this option. $10.50 and $10.50. You're paying a premium for this, dude. If it's $1.50 that I'm calculating, implied volatility for next week is $1.91. If you're lucky, you can take a trade for $2. Here's what I would do on Rivian. If I'm going to take this trade, I'll risk $200. Okay. If I risk $200 and Rivian does something fantastic or terrible, then this goes from $10.50 to maybe $13, right? I get a $2.50 move or a $3 move. Otherwise, I'm just wasting money, because the expected move is so minimum. If we could trade like 25-cent options, this might be a little bit better, but 50-cent options, I think it's spacing you out too much where you don't have really the agility to put your option prices where you want. And for the expected move as $1.90, you're paying a premium on top of that. If I'm calculating $1.45 or $1.50 move and I'm paying $2.10 for it, I'm already behind. That means I've got to have price cover an extra 50, 60 cents, which in a stock that's only $10, man, that's a big move. That's like you need an extra 10% move. So I just think it's a bad trade. But I'll say this, just for fun, I'm not going to take the trade. I don't feel like wasting money. But as we talked about it today, this is going to be a hypothetical. We'll do a 10.50 long straddle, and it's for $2.10 to $2.15 debit. So you and I can talk about this later in the week. If we have earnings, you go out to next Friday, the 17th, but you can put on this trade right here. And guess what? If tomorrow's earnings, Rivian's at $14, maybe this thing's trading for $3.50. You made a couple bucks on it,
I don't like straddles.
I don't either.
That's a bad idea.
I don't like this trade at all, which is why I'm not going to take it.
Okay.
Yeah. So, but I just want to price it out and see, this would be the trade. And if anybody's like gung ho on Rivian, the people I feel bad about for Rivian would be the people that were, hey, I'm on the early wait list to buy my Rivian vehicle, and I get to own the shares at $70 pre-market before we go public. And then they go public, and all of a sudden, could you imagine getting the ability to own an IPO early at $70, and all of a sudden it's up to $180, and you're loving this thing? You're like, oh my gosh, this is the best thing ever. But if you didn't take profit, you're sitting here holding the bag at $10.50, down 90% from where you started. It's just awful, man. So I don't know what this ever becomes outside of a buyout target. If Rivian's going to be, hey, we can't afford to stay open anymore. Amazon, would you like our technology? Would you like our cars? Would you like our this? And maybe Amazon becomes, an EV spinoff because they have the Rivian that they bought in 2025. But I think a lot of these EVs are that. I think a lot of them are buyout targets because they can't survive. They can't survive long enough to stay in the game. This happened to Workhorse, Lordstown Motors. This could be a Fisker. This could be a Lucid. This could be a lot of these. Who knows, man? EV was great and is super exciting, but now it's not. I think the reality is it's more expensive. Demand has dropped like crazy. The prices are coming down, and the expenses for an electric vehicle are higher. So your margins are being squeezed like crazy, which is why Tesla's been dropping prices so crazy. So anyway, I just think EVs are a bad spot to be right now. In Rivian, there's nothing about it that gets me excited. I'd rather trade Palantir than trade Rivian.
Gotcha.
There you go.
I'd rather own Palantir.
Yeah, there you go. That's probably even better. Longer term, So it's funny. That's one of the few shout outs that I've seen. You're giving Kathy Wood. Her ears are burning right now. She's probably all excited. That's one of her disruptive technology plays is actually catching some fire. I honestly don't even know if ARK is even in Palantir anymore. I feel like they dumped it when it's down here at $7 and took a huge loss. Just going by the nature of how they perform. But speaking of ARK, and then we'll wrap it up here. Yeah, I think this is such a long ways off. We'd have to see another pretty big growth run for this to be. I don't know. Maybe ARK never comes back to 160, but disruptive tech.
If she realized a lot of loss already, then
did.
Probably not. But if she's still holding, then
yeah, I mean, from what I've seen, the timing of those trades have not been great, and I think a lot of it is there's pressure, right? I mean, you're trying to maybe reallocate, you're trying to rebalance. I mean, would you want to sit in an ETF that has zero inflows and just outflows because your choices and your ETF makeup are just so crappy? I mean, that'd be an awful position. So I'm sure there's a lot of moving and shaking just to get more inflows or get some investors stoked about growth but I don't think anybody's stoked about 5-year growth. I mean, Nvidia and semiconductors might be the only space right now where people are like, it's going to go. I'm really more curious on XLU. I took a position. Man, this thing is freaking up, man. Wow. I did this on XLU yesterday. I just put in, I'm just going to do a wheel strategy. I got a 95-cent credit for a $68 put. I'm going to own some shares of XLU, partly because, man, this thing is ripping so aggressively. This is like a 13 to 14% move to the upside, which I know isn't a lot. But if I own the shares at 68 and I can sell some calls against it, lower the cost basis a bit more. The nice thing is a stock that only cost me about $68, I'm getting a 50+ cent dividend every quarter. That's not too bad. That's not bad at all. I mean, think of it this way. If every quarter I can, without even selling a call here, Frank, if every quarter I lower my cost basis by 50 cents, that's pretty good. So in a year's time, I'm taking off $2 of my cost basis with a dividend. That's pretty good, man. And obviously, if I want to sell a covered call, I probably wait until price is up here and it's already appreciated 15%. You take a 15% move, right? A 15% move, and let's say that for the extra year, if we get to this high, it's around 15%. If we take another $2 out of a $68 stock, you just increase your dividend. It's the dividend juice here for another 3%. Instead of making 15%, if you close it out at the highs, you actually make 18% with dividends. That's not bad. That's not bad for a sector. So anyway, that's the boring stuff, right? Anyway.
Yeah, kind of.
Just kidding. No, it's not boring, dude. I'm just kidding. I just feel, let's see the comments just like, sell gold full margin, gold buy. It's like, yeah, whatever.
You're talking about owning a spider ETF of utilities.
Correct. Which is honestly not exciting compared to other sectors. If I want to own consumer discretionary or communication services or technology, there's way more volatility in those. Those sectors single-handedly carry the broader market the last couple of years, right? That's your Mag 7. But now it's like energy still leading the way. Utilities has made this sneaky comeback. And the nice thing about utilities is I think this direction is pretty solid. I mean, if we have a pullback, great. I'd like to, have some of that action on a pullback, but I don't know if we're going to get one. I looked at this yesterday. It was a 68, which is why I did an at the money put. Now it's at 69 and change. So anyways, what it is. If I get a sign, cool. If I don't, then I guess I'll just make $100 per contract. So, all right, bro. Let's chat. I mean, anything else earnings wise? Anything else this week? I mean, I'm going to take, it looks like I'm going to take a freaking loss today at NDX, which sucks. I don't want to.
I want to look at off stream. I'm going to look at Shopify and see what I want to do with that. And then I want to look at Uber as well. So
I looked at Uber. I priced it out. I didn't like it. I looked at it the same way, like earnings, post earnings. Uber didn't price out to be an effective trade for me. Shopify did get in. I think I typed it in our chat. So 77 by 95. So it cost me 770. The expected move is 13 to $15. It's right here. Here's Shopify. So that's what I calculated out. I went out to next Friday. I've got a $15 to $18 max profit. But the expected move is going to be hopefully $13 to $15. If we get that initial move on the reaction, hopefully my 770 debit can be showing 970, 1070 credit. I'll take the profit prior to waiting to expiration. But if we see a big blowout move on Shopify, awesome. If we see a huge miss on Shopify, awesome. I just want to see that volatility.
Yeah.
So I'm happy making a couple bucks there if I can.
Cool.
So
All right.
that should do it for me here. But yeah, let's keep the combo going offline. And other than that, I don't really see a lot, man. Shopify, I'm fine with. We did Disney, we did Palantir. I think the other one you actually showed me TTD, so I got in that one. I looked at Airbnb yesterday. I didn't really love it. I looked at Uber yesterday and Lyft. I didn't really love it. I'm certainly not going to trade a meme stock like AMC. Marathon Digital, that's a Bitcoin mining company, maybe, but it'd be similar to Rivian where the prices just aren't going to be great. So I probably won't touch that. I think I'm good on earnings. We've got CPI and PPI next week. I might trade a lot of indexes next week with volatility. This slow freaking melt up it's just annoying me. Like the NDX trade I thought was pretty solid, but until it's not. I mean, we're just up on the day. We got 3 daily pivots in a row. I do have some pending orders trying to get filled, but what's that?
The open interest is down for COT, so there's a lot of lot of people getting
no seller market. Everyone, it's the low volume drift. There's just no sellers. Yeah. Yep. And again, there's no sellers until there are, and maybe those sellers are back up here, right? We hit some levels, and we've got gaps. We got gaps.
That could be a broken wing play there.
Sellers get more active when it's appropriate, and it's another wild sell-off window. But until then, it's like we'll just work our way up in this very slow drifty market.
I think that broken wing play could be good at the highs.
It should be. I'm going to look at it today. Yeah, I was curious. I mean, I think I have a bunch down here. I have like 3 or 4 broken wings that are probably going to be full profit, over the next, I think I go out to like May 17th and then another one out to June 7th and like May 31st. I've got a bunch of them out there that are all down here. But yeah, I might revisit the ones at the tops and try to give myself a little cushion in case we breach the highs. But anyway, fun stuff.
Yeah, we'll talk about it.
Guys, John. All right. Thanks, Frank.
Yep. Thank you guys. And thanks, Chris. I'll talk to you pretty soon.
Sounds good. All right, buddy. Hey, everybody. Thanks for watching. Subscribe to the channel. Like the good stuff. This is great. Enjoy the day. Bye.
Bye.
Thanks again for watching today's show. Our goal at A1 Trading is to share free value to you, our audience, through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more, lest ye walk the plank. Join our crew as we head out to go long on gold. See you next time.